Greetings. Today is Monday, December 1st, 2024, and this is our monthly market monologue. And we're going to go into a little bit of depth reviewing the stock market for the month of November, as well as some year-to-date stats. In particular, we're going to look at two different sectors of the S&P 500, one towards the bottom of the list in terms of year-to-date performance, and one surprisingly at the top of that list. And we're going to talk a little bit about what that might suggest for the road ahead. And given the fantastic month of November, we'll also spend just a minute or two talking about some possible scenarios for what we might see next. That said, let's dive in. On the screen right now, we have a monthly candle chart for the S&P 500. So remember, every candle on the screen represents a month in time. That makes this the month of November. Very positive month. In fact, the best month of the year for the S&P 500. If we switch the screen and instead look at the equal weight version of the S&P 500, again, a very strong month and again, the best month of the year by some measures. NASDAQ also had a very strong month. The Russell 3000, we'll spend a little bit more time looking at this. This is a broader measure of the U.S. stock market because it's got 3,000 stocks in it. It is indeed cap weighted, so there's still some problems when you look at this, but it is a much broader measure. It's not just 500 stocks of the S&P 500. It's not just the tech stocks of the NASDAQ, but it's a much broader measure. So we like to look at this to help us determine the overall participation and breadth. Now we have on the screen arguably the star of the show, at least as far as the month of November is concerned. We have the Russell 2000, or the small cap index, that we like to look at. There's two that I'm going to talk about today, but this is the Russell 2000, and you can see a fantastic month of November, and more importantly, finally breaking out to new all-time highs. So let's take a closer look at the Russell 2000. In particular, I want to talk about this trading range as well as a resistance. We'll come to that in a second. But also, let's look at the breadth. Inside of the Russell 2000, what percent of that constituent list is trading above their own 200-day moving average? Remember, the 200-day moving average is the line in the sand. If something is trading above the 200-day moving average, it is said to be in an uptrend, generally speaking. If it's below the 200-day moving average, generally speaking, it is considered to be in a downtrend or a negative trend. So what percent of the Russell 2000 is trading above their own 200-day moving average? And you can see the month ended at about 63%. This black line is actually at about 57%. And I drew that in just to highlight the prior peaks. We weren't really able to get above that level. Well, we've been above that level and back below, and it's just bouncing around. But in general, I want you to notice that uptrend. When the measure comes down, it's not going down as far. That's a sign of some degree of strength. Now, again, this two-year trading range I've got marked in this blue-gray box, and we have broken out of that. We've tested the top of that range a couple of times, but in particular, take a look at this additional blue-gray box. And what I'm trying to highlight is after we got out of that two-year trading range, what was happening is the Russell 2000 was having a hard time breaking out above the highs from 2021. That happened after the election. And then whenever something rockets out like that, there is a tendency for it to come right back in and test that. And that happened in the month of November, and it passed that test. So it retested this level and then again moved back higher, closing the month at high. So very strong signal from the Russell 2000. But let's go back and look at the Russell 3000. Remember, this is a broader measure of the U.S. stock market. Now, this black line down here is the 50% level. And again, we're looking at what percent of the Russell 3000 is trading above its own 200-day moving average. Again, 67%, a very strong signal there. But in particular, look at how long this measure has been able to stay above the 50% line. That's a strong indication. Now, if we look at the same measure with the S&P 500, it's even better. If we again look at this level here as 50%, so back in November of 2023, more than 50% of the S&P 500 was trading or began trading above their 200-day moving average. And in this case, the S&P 500 participants have been able to stay above that level ever since then. Let's switch the screens now. Let's take a look at the seasonality charts. Remember, the seasonality charts are just showing you the historical averages broken down by month. And first up, we'll look at the S&P 500. This data goes back to 1950 when that index was created. Again, you can see that November is historically the best month of the year, but November 2024 was fantastic. Looking at the NASDAQ, again, same data. November is historically pretty strong. November 2024 was incredibly strong. This is the other measure of small cap now. This is the S&P Small Cap 600, a different measure of the small cap universe. And it's important to highlight the fact that this data only goes back to 1995. But again, you see November is historically a good month. November 2024, the small cap sector was fantastic. So the next thing I want to show you is how the various sectors of the S&P 500 have performed year to date. That data is on the screen, and you can see the title of the slide is number 3 might surprise you. So let's just show you the table because it's a lot easier to read. And right now we are looking at the traditional cap-weighted sectors of the S&P 500. And you can see that utilities is number 3. Now, utilities is historically more of a defensive sector, so the fact that that's towards the top of the list kind of raises my alarms just a little bit. But I'm going to show you another sector that's towards the bottom of the list that is showing us just the opposite signal or the opposite sign. And so let's, instead of looking at this cap-weighted version, let's look at the equal weight version. So now we have the equal weight ETFs, equal weight sector ETFs on the screen, and you can see the title of the slide is Utilities moves to number 2. And so you see this is the equal weight S&P 500. I've highlighted that, but you see utilities is the number 2 sector. We have financials at the top of both this list as well as a cap-weighted sector, but let's look at the bottom. At the bottom of the equal weight sector list is the equal weight consumer staples. Consumer staples are generally considered a very defensive sector because in a recession, you're less likely to go buy a Disney vacation or to go buy a trip on a cruise line, or those are discretionary expenses. But your grocery bills, your Procter & Gamble, your Coca-Cola, those are consumer staples where people are going to continue to buy those. Well, if you see consumer staples at the bottom of the list, that is telling us that the market participants are a little bit more bullish on the economy and they're willing to take risk by investing in different sectors. No doubt I'm interested to see that it is interesting to see that utilities is still towards the top of this list, but I'm really encouraged that staples is at the bottom. So I'll land the plane by talking about some potential scenarios. Again, I'm not making any predictions here. I'm just trying to use this as an example to help you to understand how we are trying to make sure that we are always prepared for the other side of the trade. Generally speaking, December is a good month. That doesn't mean it's guaranteed to happen. Generally speaking, we get a Santa Claus rally. That doesn't mean it's guaranteed to happen. And over time, what we have seen time and time again is after we see a strong move, there can be a pullback or a reversal, if you will. And we saw that actually in the month of November. So on the screen right now, we have the weekly candle chart, and I'm using the weekly candle chart to demonstrate what I'm talking about. We had this very strong move the week of the election. What happened the next week? A little bit of a pullback. The market is time to digest those massive gains, definitely some profit taking, etc. But what happened the next week and the last week of the month of November? The market moved higher. So overall, November had a very strong month and we're able to recover after that little bit of a pullback. But in order for us to be prepared for the other side of the trade, we want to look at some other scenarios or some other levels of where we might see a pullback to. So if the market were to pull back in, we wouldn't be surprised if it pulled back into these October highs. That would be about a 3% pullback, very minor, certainly not a big deal whatsoever. However, a bigger pullback could also come all the way into these June, July highs. Again, I'm not making any predictions whatsoever. I'm simply saying this is one of the disciplines that we have to help us to always be prepared for the other side of the trade. Again, I'm not predicting that this is going to happen. Eventually, we will see a pullback. I don't think that's going to happen in the month of December, but it certainly could, and we want to always be prepared for that. That'll do it for today. Hope you find these videos helpful. If you haven't already, please hit that like button and make sure you have subscribed. The thing I would say is we're never too busy to see if we can't be of service to someone that you know. So if you find these videos helpful, maybe somebody you know would also find them helpful. Feel free to share them as you will. Until next time, thanks for watching. We'll talk to you soon.